Sounds on. Okay, great. Okay, so sorry for that and thank you so much. Okay, so sorry for that. Okay, so I was talking about stochastics oscillator, right? So it seems that there is a bit of a technical issue, right? So sorry for the hiccup. But okay, so I'll be going through stochastics oscillator. Okay, so you guys can hear me clearly and you can see my screen, right? Okay, so let's just hope that this goes well. Okay, so over here, right, so I'm going to cover stochastics oscillator, like what was mentioned just now. Okay, so I went through a quick disclaimer, and right now I'm going through the introduction of stochastics oscillator and a brief history of it. Okay, so this is developed in 1950s by George Lane. Okay, and basically he developed this with the belief that the momentum of price changes before and after. Okay, so stochastics oscillator is able to help us to identify the change in momentum, and it's very useful in helping us to forecast reversals as well. Okay, so for stochastics oscillator, essentially what we're doing is that they're going to compare the closing price, right, to the range of price over a certain period. This period can be determined by us. Okay, so this period, usually it is a 14-day period, but of course, if we want it to be slightly more sensitive, we can consider putting a shorter period. Okay, so we can consider 9 as well. Okay, so this is a range that we go through. Personally, just to share a little bit more on stochastics, right, usually I will just use either 21, 34, 55, or 89. Okay, so why would I use that, right? This is because they are Fibonacci numbers. So that's the reason why I'll use that. Okay, but usually if you load the default stochastic settings, if you put it on trading view, right, usually it is 14. Okay, so that's the typical period. So the stochastics oscillator itself, right, it's very useful in generating overbought and oversold signals. So how so, right? So stochastics oscillator, right, later when we load the indicator, right, you can see that it is essentially trading within a range. Okay, so 0 to 100. Okay, so this is a range, and usually what happens is that they will determine using about a range, right? So 20 to 80 usually when we are above below 20, right, or above 80, right, that is when we have, if stochastics oscillator is below 20, it's generally oversold. When it's above 80, it's overbought. Okay, so how we can use this in our trading, right, is that if you have, for example, a stochastics oscillator that it's at a really high number, let's say for example 97, right, and it's above the 80 range, what we want to look for, right, so this essentially potentially translates to price being overbought. So what we want to look for is an exit of the overbought region, right, where we could potentially see a reversal. Okay, so again, we will hop onto the chart and I will show you guys live examples. Okay, so stochastics oscillator tend to vary around some of the mean price level. So they rely on the asset's price history. Okay, so this is just a brief run through of how the stochastics oscillator is calculated. So generally, it isn't much of an issue because when we load the indicator, right, this is presented on TradingView for us, so there's no need for us to know whether to calculate it, okay, but just so that we could understand it slightly better. Okay, so there are two parts to the stochastics oscillator. The first one being percentage K, and the second one is percentage D. Okay, so percentage K, as you can see in this example, right, so this is how it's calculated. So essentially, right, this is calculated by taking the close. Okay, so we take the close, the most recent closing price. We will use that to subtract the lowest price that is traded of the 14 previous trading sessions. Okay, and afterwards, this will be divided by the difference between the highest price traded during the same 14 day and the lowest price traded that is during the same 14 day. So with this, we will obtain a percentage K. So let's give an example. Okay, so let me just pour an example so that's easier for us to understand. So for example, right, let's see. Okay, so let's say for example, over here. Okay, so let's say we have a 14-day high. Okay, so 14-day high at 150. Okay, so let's say your 14-day high here. So let's say your 14-day high is 150. and the low is 125. Okay, so this means how we'll calculate it, right? So this is the high, and 125 is the low, and the current closing price is 145. Okay, so this is what we call the current close. Okay, I'm just going to name it CC for short. Okay, so how this stochastics is calculated is that we are going to take the close, right, which is this value, 145, right, and then we will deduct the lowest, so 125, and this will be divided by the high, which is 150, minus the low, which is 125. Okay, so this will be a percentage, and that will give you your percentage K. Okay, so this is just a quick example on how stochastics oscillator is calculated, right? Essentially, this is taking the price. Okay, so this is with respect to prices. Okay, so percentage K is the fast stochastics indicator, and percentage D, right? So we have another one, which is percentage D. Okay, so percentage D, this is what we call the slow stochastics indicator. Okay, so why is this a slow stochastics indicator, right? Can anyone make a guess? Why do you think percentage D is considered a slow stochastics indicator? So is there a reason why stochastics D is considered as a slow stochastics indicator? So can you guys make a guess? Why do you think percentage D is considered a slow stochastics indicator? Okay, so just type your response in the questions tab. Okay, so, okay, yes, okay, so I have, yep, so Daniel, it's over a longer period of time, yes, okay, so stochastics D, right, is considered a slow indicator because this it's usually taken, right, so how this percentage D is obtained is by taking the 3-day moving average of K. Okay, so stochastics D is usually obtained by taking the 3-day moving average of percentage K over here, which is why if we load the chart, you can see that generally for percentage D, it is smoother, okay, as compared to K. Okay, so we will be hopping on to that later. Okay, so this is the general foundation of stochastics, right, and how it's being calculated. Okay, and we have also covered the difference between K and D, right? So when we load the indicator, you can see, right, there is a difference there. Okay, so the next slide, right? So we talked about stochastics oscillator being range bound, right? I mentioned that it's between 0 to 100. And this is very useful in helping us to identify overbought and oversold region. Okay, so overbought and oversold region, right? Okay, so this is very useful. Okay, so over here, right, we have the range bound between 0 to 100, and stochastics oscillator charting generally consists of 2 lines. Okay, so it consists of 2 lines over here, and the crossover between 2 lines can indicate a shift in momentum. Okay, so what this means, right, you just think of it like in this example, right, we're essentially talking about here, right? So in this case, right, they are basically talking about the percentage K and percentage D. Okay, so for percentage K and percentage D over here, right, percentage K is considered a fast moving oscillator, right, whereas for percentage D is a slow moving oscillator. So for those of you guys who are familiar with moving average, right, essentially what this means is that when the percentage K crosses above percentage D, this generally, you can think of this as the fast moving average, right, or the more recent prices, right, momentum is stronger than the previous ones. Okay, so in this case, when percentage K crosses above percentage D, it translates into an upward momentum for us, right, or a bullish momentum. Of course, this is just looking purely at the indicator. There is, it's important for us to look at the key levels as well. Okay, so there's a strong upward momentum. When your longer term indicator, right, or the faster moving average, right, crosses above the slower ones. Okay, so this is essentially what it means, right? And this point that we have. So this consists of two lines, and we also have the bullish and bearish divergence, right? So bullish and bearish divergence can be an exhaustion in momentum. And the reason why it can be an exhaustion in momentum is because when you look at bullish and bearish divergence, right? Essentially, when we look at bullish divergence, it just means that prices are pushing lower. Okay, so this is price is pushing lower and lower over here, but your stochastics oscillator is actually forming new lows, okay, higher lows. Now, what this translates to, right, essentially, it means that the downward momentum, right, can be waning. Okay, so that could be an exhaustion in momentum because right now prices are forming lower lows, but your stochastics is forming higher lows. Okay, so again, we will hop onto the real chart for that. Okay, so this is just a brief overview of what bullish and bearish divergence mean and how we can use it in our trading. Okay. Okay, of course, with the stochastics oscillator, right, there are always limitations, right, with every indicator that we have. So the first one, right, stochastics oscillator in general tend to produce false signals. Okay, so they can produce false signals, especially because stochastics oscillator in general, they are more useful when prices are trading sideways. Okay, so it measures a range. So the overbought and oversold region, right, it's useful when prices trade sideways, but it might not be as useful when prices are trending. The reason why, so it's because when prices, for example, they are in a really strong uptrend. Okay, so just think of this example. When prices are in a really strong uptrend, it keeps pushing higher. Your stochastics indicator, it's most probably going to show that it's constantly in the overbought region. Okay, it's constantly above 80. It's gonna stay in the overbought region for a long time, right? So the problem comes when we look at our stochastics oscillator, right, and see that it's above 80 and we take a short. Okay, so whenever it goes above 80 and we take a short, this can backfire very badly in a strong trending market. Okay, so generally for stochastics oscillator, as much as possible, it tends to work better in a ranging market, where basically in a ranging market, right, you have markets that are trading sideways. Okay, you can see that there is a clear support and resistance level that it respected, rather than a market that is trending or pushing much higher. Okay, so this is something that we want to keep in mind when we're using a stochastics oscillator. And I have mentioned, right, the reason for that is because if we are in a trending market where basically you see a really strong uptrend, prices are just pushing higher, right, you can have your indicator showing that it is in an extremely overbought region, but we do not see the reversal that we are expecting. Okay, so this is something to keep in mind, right? So for stochastics oscillator, it is better to use it in a ranging market. Okay, the second thing to keep in mind is that stochastics oscillator, they take price trend as a filter. Okay, so this is what we were talking about, right? So they take price trend as a filter, and the signals are only taken if they are in the same direction as the trend. Okay, so for example, right, how we can use this. So for instance, you have, for example, a bullish direction or a bullish bias on, let's say, Euro Yen, right? So if you have a bullish bias on Euro Yen, you are basically expecting prices to climb higher. Okay, so on Euro Yen, so you're expecting prices to climb higher on Euro Yen here, right? So this is useful when we know that Euro Yen is sitting, for example, on a strong support level. Okay, so when Euro Yen is sitting on a strong support level, along with, for example, key levels that you have, and the stochastics showing that it's exiting the 20 range, that is when it can be useful as a signal. Okay. Okay, so the second part of it, right, I'll be showing you guys hidden support and resistance levels. But just before I hop onto that, let me just pull out the chart and we will go through what we went through and try to put them in practice. Okay, so let me just pull out the chart on TradingView, right? And if you guys have any questions, again, please put them under the questions tab. Okay, so I'm gonna get the chart out. Okay, and let's see here. Okay, so this is a chart on dollar yen, for example. Okay, so I'm going to load the stochastics indicator. So right now I'm on trading view. Okay, so right now I'm on trading view. So, okay, so right now I'm on trading view here. You can see. Okay, so I have feedback that lost sound again, right? Can you guys hear me clearly? Okay, can you guys hear me clearly? Because right now it's saying that lost sound again. I have feedback that someone cannot hear me. Okay, so can you guys hear me clearly? Because the audio seems to work fine. Okay, so can you guys hear me clearly? If you can you please just put yes under the questions tab? Okay. Okay, so okay, so let me see, right? So I'm going to show you guys on dollar yen. You can see here. Okay, so on dollar yen, right, this is what we have. Okay, so let me just load the indicator on dollar yen. So you can see here stochastics. Okay, so you can actually put them under your favorites on TradingView, or you can just load stochastics here. Okay, so stochastics you can see here. So this is the default setting on stochastics. Okay, so this is the default setting on stochastics that we have over here. And when you open this up, you can see here, right? So this is the percentage K and percentage D, right? So for percentage K in general, right, what we have over here, for percentage K, the typical period that people use is 14, okay? And D, right? So D is actually the moving average that is applied onto percentage K. Okay, so for percentage D, you can see over here, right? We usually take 3. For K, the typical range it's 14. Sometimes I would use 21, 34, 55, or 89. Okay, so the reason why I use this because they are Fibonacci numbers. Okay, so there are a few ways we can use this, but that is not the point right now. Okay, so the more important point right now that we want to look at, right, is looking at the overbought and oversold region. So when you load this chart, you can see, right, when I load this chart, this upper band, right, the default setting it's 80, the lower band default setting it's 20. So what this means is that when price is above 80, so when price is in the upper region over here, right? So when it's in the upper region over here, this is what we will consider to be overbought. Okay, so let me just load this. So this is considered overbought, right? So in an overbought scenario, usually we expect prices to push lower, okay? And in an oversold region, right, we expect prices to push higher, okay? So this is how we can interpret the stochastics, right? Overbought and oversold region first. Now, so when prices are trading in a range, so let me just try and find an example where prices are trading in a range, and we can see over here. So for example, let me look gold. Okay, so I think we can see on gold, right? So gold tends to consolidate sometimes. So over here, so let me just put on the daily chart, for example. So you can see this. Okay, so over here, so let's just say that its prices are within this range. Okay, this range here. So let me just zoom into this portion. Okay, so usually it works better when it's within a range, and I'm gonna explain in detail why later. Right, so this case you can see that this is the resistance level that we have, and this is the support level that we have. Okay, so this is the range, right? So just now I mentioned that to identify a range, there must be a clear support and resistance levels that prices respected. So in this example, you can see that this is the resistance level that prices respected over here. And this is the support level that prices respected as well. Okay, so in this range, right, essentially what happens, you can see here, right, when prices tested the resistance level again, correspondingly, we want to look at our stochastics. Okay, so you can see on stochastics in this example, right, you can see that stochastics just exited the overbought region. Okay, so this is important, right? More importantly than stochastics being in the overbought and oversold region, right? Traders try to look for the exits. Okay, so because the reason why we want to look for the exit is because stochastics can very well stay in the overbought region for a long time, like in this example. You can see in this example, right? Even though prices are constantly in the overbought region, right? It's above 80, so it's above this upper band. It means that we are expecting prices to reverse, right? So technically speaking, we are expecting prices to push lower, but look at what price is doing. Price is just pushing higher and higher. Why? Because stochastics did not exit the overbought region. Okay, so as much as possible, we want to look for, number one, prices trading within a range. Okay, for example, in this example, this is clear that prices are within this range over here. This is the first criteria. The second criteria, we want to look for the exits of the regions, not within the region itself, but rather the exit. And why? It's because, number one, if it's not trading within the range, you can see that it doesn't matter if the stochastics, right? If stochastics is in the overbought region, it has no impact on price. Prices just push higher, even though we should be expecting a reversal. That is the first one. The second one is that when stochastics, right, not exit, right, you can see that it's just trending higher. Okay, so this is the reason why, right, I emphasize that when we trade on stochastics, as much as possible, try to find a ranging market, because the nature of stochastics itself, right, telling us that it's in an overbought or oversold region, the nature of this itself, it's better that the markets are trading sideways. Okay, so do you guys have any questions so far? Right, or anything that you guys want to clarify? Okay, so just now we talked about the limitations of stochastics, right, and the dangers of stochastics. So this is one of them, right, where in the case where it can give false signals, okay, again, no indicators are perfect, but what we have over here, you can see in this example, once prices, okay, so let me just clear this, so you can see this range, right, so once prices breaks out of this range that we have, right, the support and resistance range, once it breaks out of the support and resistance range that we have over here, so you can see that once prices breaks out of this range, what happens is that it goes into a trending market, it trends upwards. This is when stochastics might not be the best indicator for us. Okay, so this is one limitation of stochastics, but the thing that we can use to counter it with is just as much as possible, try to look for prices trading within the range. Okay, so for example, right, let's try and see if there are other examples. Okay, so gold tends to trade within a range, right? So the nature of gold is that it trades within a range before exploding either up or downwards. Okay, so let's see. So in this example, right, let me just pull out the other example that we have. Okay, so let's look at this portion. Okay, so let's see. So in this, you can see in this area, right, this is another example where prices are trading within this range. So okay, you can see the support and resistance range that we have. Okay, so this is the other example. So you can see that when prices are trading within the range, right, this is when, right, overbought and oversold region would be useful. Okay, here, and again at this level. Okay, so you can see this is, okay, this is probably a clearer example for the range. You can see that, let me just zoom into this portion of the chart. So you can see this range, right, where I drew the lines. So we want to focus as much as possible on this area of the chart. So you can see the support and resistance level that prices are respecting pretty well. Okay, you can see here. So let's focus on this portion of the chart. Okay, so this area here, so you can see what happened. Okay, so when prices tap the resistance, right, so when it reaches this resistance level that we have, and stochastics is near the overbought region, this is when we saw the reversal. Okay, same thing over here. right? Stochastics is near the oversold region. This is when we saw the bounce. Okay, so again, in terms of the range, in terms of 80-20, right, this is actually the number that is given as a default setting. But along the way, if you do a back test and you realize that you want to make it slightly more sensitive, we can consider 70 and 30 as well. Okay, so basically what I'm doing right now, I'm trying to change the range, okay, so that it's slightly more narrow. So this, it can be good and bad, right? It's a double-edged sword, right? So it's good in a sense that it will give me early signals. Okay, so for example, in this area, right, you can see that when prices are in this level, I want to look for the exit. We can catch the drop here. The same thing as well over here. So with usually, right, traders will toggle between 80-20 or 70-30. Okay, so it depends on how sensitive you want it to be. Of course, if you tailor it to 70-30, right, because the range is tighter, you can get many more signals, but at the same time, it could also generate many false signals. Okay, so this is on what we have for stochastics. Now let us look at bearish and bullish divergence. So just now I briefly mentioned on how we can use divergence to help us to identify potential reversals, right? So for divergence, essentially, right, we want to make sure that prices are pushing higher. Okay, so the idea of divergence, it's essentially if you're in an uptrend, right? Okay, so let me just exit this. So the idea of divergence is when we are in, for example, a strong uptrend, right? So prices are pushing higher and higher, but what you're seeing on stochastics is that it's forming a lower high. Okay, so this is an example, right? So over here, you want to focus again this portion of the chart. Okay, so this is an example of a divergence. Why so? Because you can see in this highs, right, prices are forming higher and higher highs. Okay, this is represented by the circles. So we can see that prices are forming higher highs over here. Okay, but whereas on stochastics, what is happening is that it's forming lower highs. Okay, so we can see in this example. Okay, so what this means, right, what this translates to is essentially there is bullish momentum, but this bullish momentum can be exhausted. Okay, so there's a chance that the bullish momentum can be exhausted, which is also the reason why we could be seeing a reversal. So you see, following this divergence that we have, we can see that prices actually retreated slightly lower. Okay, so this is an example of a bearish divergence, right, where essentially your prices are pushing higher, but your stochastics is pushing lower. Okay, so let's try and find an example of a bullish divergence. So an example of a bullish divergence that we have, you can see in this example. Okay, so this example of a bullish divergence here. So let me just zoom into this portion of the chart. Okay, so you can see this is a bullish divergence. Again, why so? It's a bullish divergence because you can see in this, so let's try and draw the lows, right? So this is one low, right? And this is the second low. So what this means, right, it's that prices are still pushing lower. It's still forming lower lows. But let us look at stochastics. On stochastics, you can see that this is the first low that corresponds to what we have, and this is the second low. Okay, so in this case, you can see that stochastics is forming higher lows. So in this example, what this shows is that there is bearish momentum, but right now the bearish momentum could be exhausted because in terms of the change in price momentum from stochastics, we can see that there could be a reversal. Okay, so this would be an example of a bullish divergence. Okay, it's bullish divergence because essentially prices are pushing lower, but your stochastics, it's telling you that we could be seeing a potential reversal. Okay, so this is an example of a bullish divergence. Okay, so do you guys have any questions so far? Okay, so no questions? Okay, so let me just hop back to the charts, right? So given that you guys have no questions, Okay, so let's see what we have, right, for bullish and bearish divergence. So I give an example on bullish and bearish divergence. Okay, so the next part, we will try and see if we can combine them together. Okay, so over here, right, so previously we talked about bullish and bearish divergence, but personally, I wouldn't trade just purely on stochastics. Okay, the reason why it's because stochastics itself can give many false signals. Okay, so it is important that we use key levels or key graphical levels to help us to identify that as well. Okay, so for example, right, the reason why I would say that is, for example, you can see here, right, in this example. Okay, so this would have been a nicer trade because we have other reasons that line up with our divergence. So for example, we see on stochastics, right, this is the support level that we have, and this is the bullish divergence that we found, right, where prices are forming higher lows and stochastics are forming higher lows and prices are forming lower lows. So this is a bullish divergence, but what is even more valuable is that we have a key level here. Okay, so it's all in price. Price is essentially telling us that, look, it pushes lower and price previously respected this level as a support. So it respected this level and as a support, and right now we are seeing a push back down to the same level where we saw the reversal previously. Okay, so we have reference from past prices that this could potentially be a strong support level. And on top of that, we have stochastics that's showing us that it is number one in it's below 20. Okay, so this means that it's in the oversold region. We have potential for a strong bounce. That's the first case. The second case is that we also see a bullish divergence, okay, where the downward momentum could be exhausted. Okay, so this is another example of a bullish divergence that we have. You can see in this example, okay, so we can see it everywhere. It's not just on gold, it's on other charts as well. So same thing for bullish divergence, we want to look at the lows. So you look at the lows over here, you can see that prices are forming lower lows. But what we are seeing on stochastics is that it's forming higher lows. Okay, so the downward momentum could be exhausted. Okay, so you can see over here, right? So when you draw the line, right, you can connect the lows to the previous low. You can see that for price, right, it's actually slanting downwards, whereas for stochastics, it's actually slanting upwards. Okay, so this is what we meant by bullish divergence. It's useful because it can help you to identify key reversal point. For example, in this case, right, you saw that once prices bounce off this level, we saw a strong push up. Okay, so this is one bullish and bearish divergence. Okay, previously we talked about hidden levels as well. So let me try and bring that up and see whether we are able to get to that. Okay, so let me just see. So identifying support and resistance hidden levels. Okay, so this is the second part. So over here we can see that support and resistance levels, they are generally horizontal lines. Okay, so what we are seeing over here is that there are key levels on the chart where the probabilities favor a pause or a reversal of the prevailing trend. Okay, so this I will hop onto the chart later on as well, right, to try and find if we have any hidden levels that we can see as examples. We also have support that occurs in downtrend. So essentially, what this support level means is that when you have a very strong downward momentum here, okay, so support occurs in a downtrend. So you have a strong downward momentum that's pushing lower. And right now, if you have a key support level, we could potentially see either a pause of this level before a bounce up or a slight bounce before crashing through the support level. Okay, so usually, right, it's the first case where you see a reversal. As to whether the trend or the bounce is sustainable, right, that depends on the bigger picture. Sometimes it could also be related to the bigger picture's time view. Okay, so maybe on the longer time frame, it's more bullish, right? Then on the shorter time frame, we could expect only a slight bounce before continuing on the bigger picture's trend. Okay, so resistance is the other way around, right? Resistance, essentially, think of it as a ceiling. Okay, so where prices are pushing higher, but there is a limit as to how much it can push and continue going up before we see the reversal. So of course, along with all of this, we have market psychology as well that plays a very big role for traders, right, and investors, right? So They remember the past and react to changing conditions to anticipate the future market movement. So this is essentially a little bit of trading psychology involved as well. Okay, so let's try and see. Right, so let's see what we have. So this is hidden support and resistance levels. So divergence, right? So I previously mentioned about divergence. I show you examples of bullish and bearish divergence. So this is essentially what we have. Okay, so let's see. So let's see the support, hidden support and resistance levels, and see what we can make out of it. Okay, so for the hidden support and resistance levels, right, it doesn't have to be the lows and highs. Okay, so of course, the most immediate level that we have, right, you can see over here, this is the support level. Okay, so the swing lows and swing highs that we have, you can see in this example. So for gold, especially for gold, right, you can see that at the 6.60 level as well as the 96.70 level, it's very useful. Okay, so this level is extremely useful because this level has been respected multiple times by price, right, and also by the stochastics. So how it works is that you can see that when prices reach this resistance level that we have, we saw a reversal here. Again, when it reaches this resistance level that we have, we saw this reversal again over here. Okay, so you can see that this level, right, and also we have a trend line that connects to it as well for gold. Okay, but what is important over here, this example, is that when price, or rather when stochastics reaches this support and resistance levels, right, we constantly saw a reaction, or rather a reversal in gold prices. Okay, you saw this when it tapped the 96, right, the resistance level. So these are hidden support and resistance levels that we have. Same thing for support. You can see that when prices tap this support level here, we saw the bounce once again, right? When it tapped this support level, we saw the bounce again over here. Same thing as well over here. Okay, so this is useful, right, in terms of helping us to find potential reversal points. Okay, other support and resistance levels that we have, right, it doesn't have to be at the top and bottom of the stochastics, it can be within the chart as well. Okay, so let me just see this example. So you can see the same example that we have. We can also draw a horizontal line that cuts across like that. So let me just zoom in. So you can see in this example, right, this is a hidden support and resistance level. Okay, so for example, over here, you can see this level here when you stretch it across. Okay, so this support level over here. So when price bounced off this support level, we saw the bounce once again, right? When we saw the reaction of this level, you can see the reaction of this level again, tested as support over here, tested as support, where we saw the bounce over here. Okay, so these are hidden support and resistance levels that can be very useful in helping us to find potential reversals. Okay, so do you guys have any other questions? Okay, so let me just see the questions tab and see if you guys have any questions or anything that you want us to look at, or any questions regarding stochastics in general. Okay, I have a question by Fong, right? So bullish and bearish divergence, what's happening in calculations that result in divergence? Okay, so the idea of bullish and bearish divergence is just basically recent prices that are pushing lower. Okay, but for the percentage K, it means that the previous momentum, right, the current momentum is slowing down, okay, and the previous momentum could be stronger, which sees the stochastics, So for example, right, let me just pull out this calculation and we'll see. Because for stochastics, right, in general, especially for percentage D, you are taking the average of the 3 days. Okay, whereas for price itself, right, when we look at divergence, we're looking at the latest price. So for the latest price, if it's pushing lower, right, whereas your stochastics is pushing higher, it means that the downward momentum, right, it's slowing down. Okay, because for percentage D, you're taking an average, whereas if you look at divergence, you look at the last low, you're looking at the the latest low, right? So when we have a divergence, right, depending on whether it's bullish and bearish, so in this example, if you see that it's a bullish divergence, it just means that the downward momentum is slowing. Okay, so do you guys have any other questions? Okay, so if you guys have no other questions, right, this is all the time that we have for today. Okay, I don't think there are other questions. Okay, so this is all the time that we have for today, right? So thanks everyone for staying with us. Okay, oh, sorry, hold on. I have a few more questions. Okay, so are there any specific other indicator that you would use alongside? Okay, by Daniel. Okay, yes. Okay, so I would actually use other indicators as well, right? So one of it, right, is also RSI, which we will be covering in more detail in our future webinars. Okay, so RSI is something that I'll use as well. Also, the most important thing, I think it depends on whether the market is in a trending or ranging market. If it is in a ranging market, right, stochastics can be useful, but in a trending market, I wouldn't recommend using stochastics. And the reason is because it can stay in overbought and oversold regions for a really long time. Okay, is there a momentum indicator you would use with a trend indicator, or just look at price action? So in response to that question, right, if the market is trending, you want to consider other indicators, for example, like moving averages. So that would be something that's more useful. You can also consider Bollinger Band, right? Bollinger Band is useful in helping us to identify the volatile movements. Okay, even though Bollinger Band by itself, it's actually works better in a trending market. Okay, so how to predict a ranging market to consider stochastics? Okay, so a question by Fanam. Okay, so in a ranging market, right, essentially what you want to do is like what we did just now, right? When you draw the support and resistance levels, it will generally respect price. Okay, so it moves in a sideways. So when you draw your horizontal lines, right? So let me just pull this out real quick. So when you draw a horizontal line, you can see over here in this example. So when you draw the horizontal lines in a ranging market, prices would follow this support and resistance line. So there is a range, right? As the name suggests, ranging market, there is a range that price respected. Whereas in the trending market, you can see that it doesn't, right? So you can see this level here, right? Or for example, in this example, prices are just continuously pushing higher. Okay, it doesn't go in a range. So if you want to identify a ranging and trending market, just draw a line across. If it keeps pushing higher, it's generally in a trending market. Okay. So I think these are all the questions that we have, right? So these are all the questions that we have, and let's see. Okay, so I don't think I have any more questions. Okay, so thanks everyone for today, right? So sorry for the technical hiccup, and thank you for staying with me till the end. Okay, so take care, stay safe, trade safe, and for all the future FP webinars that are coming up, right, you can just go to FP Markets. Okay. Okay, so you will have the schedule, right? It shows us the schedule of the future webinars that are coming up. Okay. So you can see over here. Okay, so this over here. Okay, so you can see the webinars that are coming up here. Okay, so I think that's all the time that we have for today, right? So thanks everyone. Stay safe, trade safe, take care, and I'll catch you guys again soon. Goodbye.